Hello, y'all. Today I'm going to be talking about how you can analyze capital structures using options. You'll recall in my last video, I talked a lot about how options are an asymmetric way to bet on underlying assets. And this is because you kind of have a premium that you pay, which is your cap downside. And in the case of calls, you have an unlimited upside. In the case of puts, you have a lot of upside, a lot more than the premium that you're paying. So because of this asymmetry, when the underlying goes up by X, you're going to make a lot more on your option than you're going to lose if the underlying were to go down by X in the case of a call, and the opposite is true in the case of a put. There's always going to be that asymmetry. And because of that, options trade at a premium to their intrinsic value, the value of the option if you were to exercise it right now. So you can see in this example where with a spot of 120 and a strike of 100, so an intrinsic value of 20, you can see using a Black-Scholes calculator that the option actually has a theoretical price of $26. And you'll remember that this premium, the time value premium, whatever the value of the option is minus the intrinsic value, is largely a function of the volatility and the time to expiry. The larger those are, the more the time value premium will be. And another important concept when it comes to options is the concept of put call parity. So if you think about these three distinct trades that I'm making here, where I issue a $95 zero coupon bond, I use the $95 to buy stock X, and then I buy a put on stock X at a strike of 95 for $5. Think about the payoff here. I basically, assuming that I sell stock X in 1 year, have a capped downside of $10. The $5 I paid for the put plus the $5 in interest. And from there, it's really all upside. I'll start to actually profit if stock X can go above $105. And you can see that this payoff really resembles that of a call option. And this is no coincidence. This a underlying asset, the stock, plus a put minus a treasury because you're borrowing money equals a call option. So this relationship will always hold true, assuming the same strike price and that being the price of the spot. You can see that the underlying plus the put equals a call plus a treasury. And we can apply the same framework for capital structures. So you'll remember that the asset value of a company is just the enterprise value plus all of the other non-operating assets, like cash, for instance. And all these assets are financed using a combination of debt and equity for the most part. And this is called a company's capital structure. A capital structure is how you are financing the assets of a company. And we can kind of think of these claims on the asset value very similarly to how we think about calls, treasury, and the put here as claims on the underlying asset. It really is a very similar concept. In this case, equity is a call option on the asset value of the business. And if you kind of just think of equity conceptually, this makes sense. Equity has all of the upside after the debt holders are paid off. That's why equity is called the residual claimant. So you can kind of think of equity as a call option with a strike of the amount of debt and a spot price of the current asset value and a timed expiry of the company's runway. And you can kind of think of debt as a long treasury plus a short put option in that, let's say that it's a $200 loan. You are basically going to earn, in this case, if you buy a $200 treasury, you're going to earn the risk-free rate. So let's call that like 5% of 200, so $10. And then you are going to earn a small put option premium for selling a put option. And that kind of represents the credit spread. A loan earns a return in the risk-free rate and then the credit spread. That's kind of the interest income that a loan earns. And you can kind of show that through this model where debt is a long treasury plus a short put. Although a debt holder can lose money because they are selling a put option. If the asset value goes below the strike price, the amount of debt, um, thinking in corporate finance lingo, if the asset value goes below the amount of debt, the debt holders are going to start to eat the losses. So, very much like if you are selling a put, you are still long the business overall, but the risk reward is different than equity. So, you can see this really makes sense if you kind of just think of it as put call parity, where the underlying, in this case, is the asset value, the call is the equity, and the treasury minus the put is the debt. And this should always equal each other. And we know this equation is true. The asset value of a company equals the equity plus the debt because equity and debt are a function of the asset value of the company. So thinking about this more, like I said, both are long the underlying assets. They just have very different risk reward, right? Because corporations have limited liability for the most part, equity kind of has a cap downside, whatever you are putting in, whatever you're buying the equity for, but it has an infinite upside, making it long gamma. There's that asymmetry. Whereas debt only has the upside of the interest income, but has the downside of whatever you're lending, the principal amount. So debt is very much short gamma. It has opposite risk reward characteristics from equity, even though both overall are long the asset value overall. So let's think about how you lose money in a debt security. If the underlying expires out of the money above whatever the strike price is, then you're going to be fine, right? If the asset value exceeds the debt, you're not going to lose any money. But if the underlying expires in the money, the debt holders start to lose their principal. Think about it like this. If you make a $200 loan and the asset value expires at $0, you're going to lose your whole $200. And in this case, if you think about the instrument, it's a long treasury, so that would be worth $200. And then it's going to be a short put, which you'd be liable for $200. So the debt instrument would be worth $0 total. So that's really how you're modeling these debt instruments. And this concept was initially published by Merton, an academic in the early 1970s. And you can see these payout diagrams, which really resembles debt and equity. Like I said, both long, but equity has much different risk reward than debt. And you can kind of, like I said, break down the return of the debt into the risk-free rate component and the credit spread component. The risk-free rate component comes from the fact that you are long a treasury. The credit spread component comes from the fact that you are selling a put on the asset value of the business. And then equity is a long call on the asset value of the business, where the interest income paid to the debt holders kind of represents the dividend yield on the call option. Even though it's not an actual dividend and that it's not going to the equity holders, it represents, just like how a dividend to the equity holders would be for a call option, a erosion of value that's not going to you. And just a note, the treasury component of debt assumes continuous compounding. That's just a part of Black-Scholes that I wanted to note for the calculations I'm going to do in a few minutes. So let's actually think about how we value debt instruments. I'm not going to go through this first bullet point just because it's a little bit complicated, but let's just think first principles here. Debt is going to increase in value when interest rates go down because the cost of capital will go down. So you're getting paid a premium for the instrument you own. Or if the credit becomes less risky, because at that point you're getting overpaid now because you are getting paid based off the prior risk and now the debt is less risky. And it's very similar to how we can think about the value of debt if we're using options. If the put premium that we're getting paid based off of the time of issuance is too much, and now the company has become less risky, the current put premium is going to be less, which using this equation you can see is going to result in the debt trading at a premium to par. Same thing if rates were to go down, if you think about the spread when it comes to that zero coupon bond. So let's kind of forget about this a little bit complicated equation and let's actually look at a real example of a debt instrument with a 60% LTV, 25% implied vol. For reference, that's around the average for the S&P, and a 3-year maturity, 5% risk-free rate. So you can see here at issuance, the put is worth $4.22, which is around a 50 bips credit spread. So not very risky, right? If the risk-free rate's 5%, this instrument is paying around 5.5%, which is not really that much at all. And that's because this credit really isn't that risky, right? Relatively low vol, decent LTV in only 3 years. So it's really a good credit. Relative to other debt instruments that might have higher LTVs, higher volatility. You kind of can sleep at night knowing there's enough equity cushion, not a ton of volatility. This put is likely never going to expire in the money, so I'm really hopefully never in most instances going to be exposed to losses because I'm selling this put. So the premium overall is pretty low that the creditors are in effect selling. And then you can see that the call option is going to be worth around $200, which makes sense, right? Because the asset value is 500. It's just kind of a rounding error. 500 minus 300 should equal 200. If the business is overpaying the creditors for the risk that they're incurring, the equity is going to trade at a discount to the asset value minus the face value of debt and vice versa. So that's how you can kind of think about the relationship between asset value, debt, and equity. And from like a corporate finance first principle standpoint, that makes sense. Um, so continuing on, this I'm not going to really get into, but if you're really interested in this, I recommend reading this. And this kind of explains the rounding error on the previous slide. The actual original Merton model is a bit less applicable just because it assumes zero coupon bonds, where for the sake of this exercise, I assume a normal bond that pays interest every year, which is more applicable. But there are a few rounding errors as a result of that because you model the call a little bit differently than the put because of the dividend yield. I'm not going to really get into that though, but if you're interested, I recommend reading this slide and commenting below. Let's think about this from a more practical standpoint. How can we think about how these variables affect credit spreads? Again, credit spreads are the rate of return a lender is getting paid in excess of the risk-free rate. What would happen if the volatility went up? You can see here, if vol goes from 25% to 40%, the put premium is going to go up so that the credit spread is going to go from 52 bips to 266 bips. And if we take that a step further and we move the LTV from 60% to 80%, the bips are going to go from 266 spread to 635 spread. So assuming a 5% risk-free rate, this would be an 11.35% interest rate, which is a pretty substantial premium to the risk-free rates, and just overall a decent amount. So you can see the riskier things get from an LTV and vol standpoint, the more that lenders are going to require for the put that they're essentially selling because the less of an equity cushion and the more vol, the more likelihood that that put is going to expire in the money and that lenders are going to be on the hook for some of their principal. In other words, they're going to lose some of their principal. And you can see that using these variables, you can really kind of figure out how to price debt if you know the vol and you know the asset value of the firm. And just kind of to reiterate, debt is almost always going to be short gamma, short vega, and long theta. They have this negative asymmetry. They don't like volatility because of the negative asymmetry. And then they just kind of want things to get done. They want the company to pay back their interest and just move on. Whereas equity holders like time because of that asymmetry and they're long vega and long gamma. And this is kind of a weakness of the Merchant model, actually. You can see when the time to expiry goes from 3 years to 6 years, the put premium still goes up, which makes sense conceptually. But because of the fact that it is not nearly doubling, the spread actually, if you kind of, do an annuity and, annualize see what you're actually paying per year in interest, the spread is actually going down from 635 to 443, which doesn't really make sense because if you think empirically, usually the longer dated the debt instrument, the wider the credit spread. But the reason for this is just because kind of the math behind options. Volatility scales with the square root of time rather than linearly. So you can see that assuming a 40% annual vol, the 3 year vol would be 69%, and then the 6 year vol would be 98%. So from 3 years to 6 years, it's not even close to doubling. And that's kind of how options are being priced using this volatility. And you can see it's only going from 51.87 to 66.48. So not even close to doubling. And because of that, the credit spread is going down, but this really isn't realistic. But for I guess the means of this conversation, it's not super relevant. It's just kind of a weakness of the model. So kind of just a last few things. I wanted to talk about other applications of this framework. First, which is going to be the subject of my next video, how a liability management exercise, which is basically an aggressive out-of-court restructuring, how that affects the various stakeholders in a capital structure. Usually, these transactions are designed to give the company more runway so that the equity holders don't have to hand the keys over to their creditors. And a lot of times this is done through maturity extension, additional liquidity, and a lot of times they even get the creditors to give up some of their principal. So because of this, the equity holders' effective out of the money call option becomes more valuable. And because a lot of times some creditors are participating in this transaction to the detriment of the non-participating creditors, the participating creditors get a better put option after the transaction is done, and the non-participating ones get a worse off put option. So I'm going to talk about this in my next video, but this is basically a transfer of value from some creditors to other creditors and the equity holders, and you can kind of model how the value is transferring using options, which is really interesting. Additionally, when a company is a lot of idiosyncratic vol, so for instance, like MicroStrategy, the company that just kind of has a pot of Bitcoin as their core business at this point, they are super volatile because of how volatile Bitcoin is. And you can leverage this volatility by issuing warrants or instruments that have implicit options, such as convertible debt or even equity itself, because equity is a call option, right? So you can issue asymmetric instruments, instruments that are positive gamma, and get paid a pretty penny for them versus just issuing vanilla debt. It doesn't make sense to do that. MicroStrategy or strategy now, from a cost of capital standpoint, it makes a lot more sense to issue equity than debt because of how these options trade. So it's kind of interesting, actually. Systematic vol, when you think about like CAPM, makes equity cheaper, while IdeoVol makes equity more expensive because volatility benefits equity holders because it's an effective call option on the business's assets. And then lastly, if you want to hedge your exposure, let's say that you own debt and it's relatively illiquid and it has a delta of zero point 0.1, and you kind of just want to remove your exposure to the asset value of the business, then you could short $10 of equity with a delta of 1. And now you kind of have a delta neutral position, albeit it's important to rebalance this position as the asset value moves because of the fact that there's going to be gamma, which is changing it and making it where you're not actually delta neutral. But it's interesting that you can hedge using equity if you own debt or vice versa. And then just to kind of review this model, while not perfect, it kind of lives in a perfect world, but it really does help us inform how debt should be priced and how you can kind of think of equity and why volatility benefits equity because of like the limited liability structure of corporations. I think this model is really helpful for kind of thinking about that. And just a reminder, equity is a call option on firm's assets. So long gamma, long vol, short theta, and debt is a short put option plus a treasury. So very much short gamma, short vega, and long theta. And you can kind of use the variables such as like the asset value and the vol to price debt and equity. So this is a really interesting concept, and I'm going to be talking about it more when I talk about the liability management exercises and how you can kind of look at options to see how value is transferring. So I hope you all found this helpful. Thank you very much.